Shawn, welcome back to the show. If you've been here before, if you're new, welcome for the first time. We did a video, recently about Revlon and the business lessons we could take from the Revlon bankruptcy. That prompted a comment asking about whether Revlon stock had any value. Is Revlon stock worthless? And so I thought that was a good thing to zoom in on. We love to see the comments here on the channel. Of course, we encourage you not to comment with anything that's confidential because it is public. But if you have public-facing questions or things that you're thinking about, please post them in the comments. We do look at the viewer questions. If we see a trend, if we see something coming up, or if we see something just plain interesting, we may well do video on it. And also, I try to reply back to a lot of the comments. So this one here was a comment from recently. Somebody said, hey, I bought Revlon stock and I want to figure out, does it have value? Did I make a good investment? Is it a bad investment? So we're going to go today into looking at some philosophies about stock, about bankruptcy, and really this should get you a good grounding so you can use this as some of your tools in doing an analysis of what you should and shouldn't do. Now, as always, we'll talk about some legal issues, particularly around bankruptcy today. Not legal advice. Consult your legal advisor. Also, not financial or investment advice. I'm not here to tell you whether to buy or sell your Revlon stock or not. What I am here to do is to help you have some tools to look at your stock so you can make an analysis, particularly with respect to your financial or investment advisors, make your own decisions. But you should have a better framework for making decisions after today's show. Balance sheets, right? This is the basics of company financials. There's a couple major financial statements that you'll see. If you go to a company's, audited financials, balance sheet, income statement, statement of cash flow, reconciliation of statement of retained earnings, right? These types of things really paint the picture. These are what accountants spend so much time on. These are what Wall Street analysts look at. Let's zoom back to the basics on a balance sheet. Balance sheet's supposed to balance. You have assets on one side of the balance sheet, and then on the other side of the balance sheet, you have liabilities and owner's equity. Now, if it's done correctly, what you'll see, and these are often done on facing pages back in the old days when they used to print financial reports, the assets side will have a total assets number, and then the liabilities and owner's equity will have a total number, and those two should match. They should balance. The way we do double entry accounting here in the U.S. and other parts of the world with different principles, stuff goes on both sides of the balance sheet at the same time, and it's a little bit complex when you learn it the first time, but entries always go through. They flow through either through the income statement or move around the assets and liability portion. But the two of those always balance, right? So assets equals liabilities plus owner's equity. You can do a little bit of basic algebra and go assets minus liabilities equals owner's equity, right? You're moving the liabilities over from being liabilities plus owner's equity to being assets minus liabilities. It's the same equation. That becomes important to our analysis, right? Because the owner's equity, what's there for the owners, is the amount that the liabilities exceed the assets. Now, a quick precautionary statement is most of the balance sheet is valued at historic cost. So in a changing environment like we have now with inflation, with the real estate market we have, many of your assets are, the numbers you see on the books may not be the real market value, right? So that's another caveat with this, right? There's what the balance sheet actually shows, which is generally tied to historic cost with some exceptions, versus the way that we do liabilities, which is often closer to true value, the dollar amount of liability. So there can be some discrepancy between the actual value of a company and what owner's equity is reported in a balance sheet. Plus the balance sheet typically doesn't take into account goodwill or the value of the name, the brand, the trading equity, right? So typically in most companies, unless something unusual has happened, maybe a recent acquisition, there is no asset that corresponds to the value of the brand. And that is something to consider in Revlon. It was very important in the case of Hertz. When Hertz went through their bankruptcy, not too long ago because people came in and bid the company up because Hertz had such a strong brand name and connections in the industry that when they had kind of a weird temporary issue because of the travel shutdowns and went into bankruptcy, people were still excited about that Hertz name and brand. So there was some equity there that really wasn't shown in their income statements, and they were having temporary cash flow issues. Because you could have a bankruptcy brought about by temporary cash flow issues, right? You could have a company that's strong, ends up in bankruptcy just because they can't pay their bills because maybe they did a bad job managing their liabilities or they had some temporary blip in their business. You need to look at how bad are the liabilities for any given company, right? So as we're doing a bankruptcy evaluation, we want to look at those liabilities. What's going to happen in a bankruptcy situation is you are going to have a bankruptcy trustee come in. They are going to look at that company as a total. They're going to typically do what they call marshaling the assets. They're going to figure out what all the assets are, what's there, buildings, software, real estate holdings, land, inventory, contracts, receivables. They're going to look at everything the company has, potential lawsuit claims. And it's generally the job of the bankruptcy trustee to make the most value out of those assets and pay them over to the creditors. And there is an order of priority. We'll get into that in a minute. Some people get first in line than others. And generally your creditors are going to be first in line versus your equity holders. That's just a principle of the way the legal system works, right? Debt gets paid first, equity is second. It's just an order of priority. So we got to see how bad the liabilities are. What do we have as assets? And again, the balance sheet is not going to be very or 100% accurate because of these intangible assets and these historic cost principles. So real value of assets, not necessarily the balance sheet value of assets, minus the liabilities is going to tell us what actual equity we have left for the holders, right? So you're starting to draw the picture of how do we do an analysis of whether Revlon or any other stock has value. And then we've got to go back to fundamentals. If you read kind of the financial theory books and what underlies a lot of the Wall Street trading formulas, the buy-sell decisions of the hedge fund managers, generally there's this what they call the discounted cash flow analysis. And the fundamentals are you look at the business, you look at projected profits, projected costs, and you break that down usually on a per share basis. And you do an analysis and you say, okay, what am I getting? If I'm going to pay $100 for this stock, what is my expected cash flow? And I look at how good the company is. Maybe depending on the projections, I might get $2 next year, and I might get $2.15 the next year, and $2.35 3 years from now. And you add all that up together, and then you make an analysis. Is it a good investment or not? Am I going to get back my $100 plus sufficient return on my $100? Now, most people are going to trade out of a stock at some point. They're not going to hold it indefinitely. But the financial theory generally is, what would an indefinite hold look like? Shooting back to our friends at Revlon, what are the fundamentals? What does Revlon look like? What cash flow can we expect from Revlon? Now, certainly Revlon has a strong brand name. Everybody recognizes them as being a big player in the makeup industry. The real question is, what is the value of that brand? And there may be a lot of value in that brand. In fact, I would expect, as part of this bankruptcy, one of the things that will be explored is how can you capitalize on that brand? Could you possibly sell that brand to somebody else? Right? So we'll be doing a lot of fundamental analysis in looking at how this is set up. Fundamentals rule. I'm a value fundamentals person, and my personal investments tend to look at that. What is the value of the company? What are the fundamentals? What's the future cash flow look? There's other investors that tend to be technical investors, right? They'll look at the stock graphs, they'll look at how the market's doing, they'll look at other conditions, and they'll determine what it's worth. So let's take a moment here. I want to zoom over to an article from the Motley Fool. And this will really help our analysis. They did a lot of it here. I'm kind of adding my flavor and giving you some background that they don't give you in this video. But some of the core analysis makes sense. The stock's up, right, because a lot of people are trading at it. Um, and, there's a lot of risk because we don't know what's going to happen next here, right? So we need to look at this overall picture here of what's going on here. And so they filed for Chapter 11. There's been a lot of activity. People are jumping in, and we don't know really what's happening. Now, a lot of times what happens with these bankruptcy stocks is these companies are thinly traded. People go out onto bulletin boards and online chat rooms and get people excited. They drive the price up. Then these unscrupulous people, they dump their shares. They've run the price up. They bought their shares before they started publicizing. They put a bunch of energy into publicizing. Get everybody excited. They dump their shares, and everybody else is left holding the ball, right? And now it talks about kind of the basic bankruptcy proceedings, right? And it talks about the order of creditors, which we started to hit on earlier. This is a legally driven system of who gets paid, right? So secured creditors are generally first. So let's say somebody has a mortgage on a property that Revlon owns. They're going to look to that property first. And if there's value in that property, especially if the property value exceeds the amount of their loan, they're probably walking away with the full value of the loan paid off. That's secured creditors. Maybe people have liens on inventory or other things because they said, hey, I'm giving you this stuff, but I'm taking a lien on it, right? And there's a whole legal system about who gets priority on that and who gets to keep the stuff in a situation like this. Next will be bondholders or unsecured creditors, right? Maybe some people just lent money to Revlon. Oh, Revlon sounds like a good company. Let's ship them some stuff. They didn't do the particular things to secure themselves from a legal standpoint to make sure that they had a lien against whatever they gave Revlon. So now they're standing in line with everybody else. Next in line is preferred stock. So preferred stock usually says, hey, we step in line in front of the common stock. In the event of liquidation, pay us first. And that's why it's preferred. Also usually gets dividend rights. And then the last is the common stock, right? So you can see the people that are buying Revlon common stock are now last in line. Everybody else has to get paid forward. So the real question now is back to our fundamental analysis is, what is the value of all the assets at Revlon? Will the bankruptcy trustee collect enough money for the assets or bring in an equity investor or do whatever you have to do in order to pay off everybody? In the Motley full article, I'm not going to bring this section up on screen, but it goes on to say that what happens a lot of times in these bankruptcies is the current equity holders, people that bought in, before or during the bankruptcy, they often get reset to zero. They just look at it and they say, look, we don't have enough money to pay off the bondholders. We're going to try to make the bondholders right. Sometimes those bondholders get converted into equity. Sometimes they bring in a fresh round of equity. But the new equity, the stuff that's being issued now, will have value. But a lot of times that bankruptcy court wipes out the old equity. But it really depends on the situation and how much assets are to go around and the negotiations with the bondholders. Bankruptcies are extremely complex. So from being an outside, retail investor, normal person, any day, person that's just jumping into some Revlon stock, you don't have good insight on how all that's going to work with the bankruptcy court, what the bankruptcy trust is going to do, and some private negotiations that are probably going on right now. There's probably people that want to buy the Revlon brand. How much are they going to pay? Will they pay more than what the value of the liabilities are? How will things get reshuffled? There's a lot of open questions. The big question is, do assets exceed liability? That's really what you're looking at here in Revlon. And if you're buying the stock, you're making a bet that when that bankruptcy trustee does their work, they took a look around underneath the hood, they decide what they want to do, you're betting that there's going to be a pool of assets that are greater than the liabilities. But usually, and again, there are exceptions, but usually when a company goes into bankruptcy, what that means is the liabilities are more than the assets, or else they would have refinanced, they would have extended the terms on a loan, they would have done things to avoid bankruptcy. So almost always, when a company is in bankruptcy, liabilities exceed assets. Do companies come out of bankruptcy? Yes. Do sometimes companies come out of bankruptcy and do well? Yes, but it's less than guaranteed. So the question at the end of the day is what's left for you? If the assets are greater than the liabilities and this company has more value than what they need to pay off people and they can get that restructured, then you're going to have a going company. And maybe you just bought a stock at a cheap price because you just bought a company that's going to survive and go forward for a low price because they were in bankruptcy. So if that's your analysis and that's your conclusion and you want to make that bet, then maybe you win. But I think a lot of people, what happens in many bankruptcies, and without specifically speaking to Revlon or any other investment, what happens in a lot of bankruptcies is the assets just don't come out in value. And we are just sitting here on the precipice of a deep recession or depression, which is going to push asset values down. So will there be enough left after the bankruptcy trustee does their work? Will there be enough money to pay off the liabilities and leave something of good value for you? Folks, this is a complicated investment, probably higher on the risky scale given the uncertainty, the negotiations going on, the lack of information, because just part of the nature of a bankruptcy proceeding is we don't have full transparency of the probable value of the assets. We may have good visibility on the liabilities from filings and other things, but we don't have good visibility on the assets. A lot of things can happen. My best guess, looking at what we're looking at, this is just one of the ones where, the market has created excitement, and I don't see the fundamentals being there. Revlon is a valuable brand, and maybe somebody needs that Revlon name and will pay a lot for it, and maybe there's negotiations that are going to happen for that. And some point, maybe somebody will pay a lot for Revlon's name. But if that doesn't happen, we're probably going to see, these liabilities be big and the assets be small, which means the common stockholders are probably getting very little. Hope that's helpful to your analysis. Do join me in the comments. Again, don't post anything confidential. But if you have questions, issues, we do read through the comments. Sometimes it inspires a future video, and certainly love to have a good, lively discussion going. So share with your friends, jump into the comments, say hi to me from there. Let me know where you're watching from. Hope you've subscribed to the channel, rung the bell for notifications if you haven't yet. If you want to be a more strong business owner, business leader, this is your channel. Give us a like so that other people can see this video, and I'm looking forward to interacting with you in the comments. Catch you soon.